Hi, everyone. Jeff Yastine here, and welcome to our very first Saturday Market Insight. And joining me is Ted Bauman, editor of the Bauman Letter, Ian King of Automatic Fortunes, and of course myself. And we'll be chatting for the next handful of minutes. And we're taking this opportunity with MarketSight as a chance for all of us to talk about a few of the topics that we know are on your minds and may be affecting your investments and your own investment outlook. So one that we're going to tackle here is the ongoing trade and tariff war and its impact on interest rates. And the next thing we're going to talk about is also the idea of antitrust, since that's been much in the news, and how that may affect your tech investments. So Ted, let's just start off with you a little bit here. What's your view of this trade war situation here?
Well, I tend to look at it sort of in reverse. I tend to look at how the U.S. and Chinese governments could potentially use interest rates to basically compensate for the consequences of the trade war. I mean, there's no question but that it will affect both economies. But the problem is that we've already cut interest rates a lot lower than the Chinese, so they have more room to cut than we do. And of course, the Chinese, if they want, can spend money, to stimulate the economy directly, whereas we have a much harder time doing that because of our democratic system. So I worry a little bit that we're fighting this trade war with one arm behind our backs. But at the end of the day, I think the two issues are probably going to be quite separate. I don't think interest rate cuts do as much to stimulate the US economy as they do to stimulate the Chinese economy. So in some ways, the cards are stacked in favor of the Chinese on this one.
And Ian, what's your thought here?
I mean, I tend to agree with Ted said, where the Chinese have more room to cut rates. But, the trade wars have a much more impact on the Chinese economy than they do the U.S. I mean, let me just give you some numbers right here. So U.S. GDP is currently at 19.3 trillion. U.S. imports are 2.4 trillion. The U.S. imports from China about 539 billion. And the goods subject to tariffs are around 250 billion. So if you're looking at 10% tariffs on $250 billion worth of goods, I mean, you're talking about a $25 billion impact to the GDP. This is about 0.1% of GDP max. And for an economy the size of the US is 20 trillion, it's having a much bigger psychological impact on the markets than it actually is having an economic impact. And I think that, I think it really starts with the market impact in China and the slowdown in Chinese growth, which really has been the engine of growth for the rest of the world for the last decade, and that kind of bleeding into the U.S. market. So, I think that the Chinese have more to lose in this situation than the United States does, and I also think that the impact on the U.S. should be muted.
So, how do we, how should people approach this? Again, talking about the trade war in terms of thinking about in terms of their investments. I know for my subscribers, what I've been telling them is, look, this stuff is going on out there. There's nothing much that you can control about it. And the key thing to think about with the stock market is like the S&P 500, because of the way it's weighted, you're really talking about, a couple of dozen gigantic market cap stocks. And a lot of the stocks that we focus on in my model portfolio don't really, aren't those size. And are different valuations than these other ones are. So, yeah. And so I don't think it's going to have that much impact unless there's this overall, drain of money out of the stock market in like a true bear market. What are you guys telling people about that?
Well, I can tell you from the perspective of, my own portfolios in the Bauman Letter and the Alpha Stock Alert that one of the things I've seen is contagion with firms that people think have Chinese exposure but actually don't. And part of the message, I think, is just make sure that you pay attention when we send out alerts and say, look, this stock may be down because people think it has the potential to suffer from the trade war, but it actually doesn't. Hang on to it, don't sell it. The other thing I think that we're seeing a little bit is people unloading passive investments like ETFs that may contain some firms that are exposed to China and some that aren't. And so that also puts downward pressure on stocks that don't really deserve it. The key thing is that if it's a good company and it has good prospects, don't sell, hang on.
Yeah, Ian, it's a real conundrum, isn't it? Because in some ways you can't not invest because if you had that viewpoint, you'd be out of the market for the last 10 years and may well
Yeah.
be out of it for years to come.
Yeah, and you know what, Jeff? It's just that I've really been following this market since the end of the great financial crisis, and the list of things we've been told to worry about sounds like, the greatest AM hits of the 70s. We've got fiscal cliff, sequestration, North Korean missiles, Russia annexing Crimea. And this is just given more ammunition for the only thing that really matters. And the thing that matters is whether or not the Fed is going to raise rates at a pace faster than the market does or doesn't like. Because as long as the Fed is accommodative, there is no alternative to stocks. It's Tina, the mantra. And, it sounds like, your 80s prom date. But listen to this. The S&P 500 is up 296 points this year. 143 of those points came on 2 days, January 4th and June 4th. Both those days, Powell spoke. And what I'm looking at right now, and I want our viewers to look at this chart, target rate probabilities for the December 2019 Fed meeting. At the beginning of May, if you look to the right of the chart, the probability that rates would be unchanged at the end of the year was about 50%. The probability now, a month later, that rates will be unchanged at the end of the year is about 2%. And the probability that rates are going down by 75 basis points this year is now up to 38%. And I think that's the only thing that matters right now, because the market is focused on an accommodative Fed. And every time that people have been bearish when the Fed looks accommodative, they've gotten absolutely steamrolled. So I think
sorry, Reen, go ahead.
No, I just think that's the most important thing right now. And I think that this really started about a week ago. And I think investors are starting to wake up to the reality now that the Fed is going to be on hold and possibly cut rates this year.
And it just reinforces the idea that all three of us have been saying, which is focus on your individual stocks, focus on values, make sure you have an eye for the risks that you're taking on, but at the same time, knowing that that your stock should do okay if you make the right choices. Let's talk a little bit about antitrust and tech. That's something that I've been writing about for the last couple of years. Back about July of 2017, I remember writing a piece for our free website talking about the EU hitting Google at the time with I think it was like a $2.5 or $2.7 billion fine because of what they believed were unfair practices over a certain aspect of their business. And it seems like the tide may be turning here. Is it a threat to tech stocks? I believe that it is, especially for these major FANG type stocks, Facebook, Apple, Amazon, and Google. I don't think Netflix is as much it has an antitrust thing to worry about. But what do you guys think? Ted?
Well, certainly I think it's a threat to them because their business models to a large extent have been based on their ability to earn super profits because of the market structure that they've created. And if antitrust changes that market structure, then we would expect those profits to decline. Although it depends a lot on the kind of antitrust action that we see. I mean, you could have anything from specific regulations that limit what companies can do, privacy controls, all the way up to breaking firms into different pieces, which would be a really radical thing to do. But the critical thing for me is that antitrust processes take a long time. It took 10 years to break up AT&T into the baby bells. And so I think this is going to be a long process that spans multiple White House administrations, and there'll be different people coming and going. And the other thing is that we know that these companies have tremendous lobbying power. They've already lined up the biggest firepower anybody's seen in Washington for a while. So I think we're all going to be in spectator mode for a while. So the initial impact that we're seeing on stocks right now may resolve into a rebound. But it's going to be up and down for a long time now, so it's hard to tell where it's going to go.
Ian, what's your thought? Because especially having been on Wall Street the way you have, how are they thinking about this on those institutional trading desks at hedge funds and and the large groups that really move stocks up and down?
Yeah, sure. So, I really wonder what a breakup of Facebook or a breakup of Google would really look like, and would that even be better for investors if you break these companies up into separate parts? Because Facebook, for instance, if you really want to see where their growth is, it's in Instagram. And if you could buy Instagram and not have Facebook, you'd get a much higher growth rate than owning Facebook. There's other parts of Google as well that I think are really underappreciated by the market, such as the Waymo self-driving car project, which is going in Arizona, which I've read some analysts estimate could be worth $100 billion of Google stock. So it's hard to tell, really. I do agree with Ted that it's going to take a lot more time to break up these companies than we think, because they really are entrenched in government right now, and they've got very strong lobbying powers. But if you want to see what's happening overseas, I know that the UK has imposed a 5% Facebook tax on the social media company over there right now. So maybe we'll see something similar for starters in the US and not have a total breakup. But it's really, in the 21st century, data is just the new oil. And we're talking about these companies that control all the data. And it's very hard to break into the markets that they're in right now. I mean, Amazon, for instance, has filed patents to create something that's going to ship you goods before you actually order them, because they feel like they can predict it better. And yesterday I was reading that they're commercializing drones now to deliver goods. There are just no other e-commerce retailers that have as much data as Amazon does, no other social media companies that have as much data on people and their likes as Facebook, and the same thing with Google. I mean, your Google search histories are so valuable to that company because advertisers know what they can and can't put in front of you. So I just think it's not an easy question to answer. And I think it's also going to take a big catalyst to push people away from using services they really like. I mean, take Google Maps. I don't know what my life would be like if I couldn't go on my phone and look up something or look up reviews for a restaurant. It just has made my life so much easier. But on the flip side, Google owns all that data. So I'm giving up some of my privacy for something in return. In the decentralized space, I know that there are some projects that are kind of starting this idea of a decentralized internet where you hold on to your data and don't give it to any centralized company. But I think we're a few years away from that right now.
I'll tell you, my biggest concern here regarding antitrust and these key tech stocks is mainly that it creates this sort of cloud of uncertainty. Like you said, it'll take 3, 4, 5 years. I looked up Microsoft when it faced its antitrust issues in the late 90s, and it took about 3.5 years for all that to work itself out. But the key that I see on this, because of that uncertainty, I do think that it may be putting a cap on the upside for these stocks, Google, Apple, Amazon, Facebook, simply because of that uncertainty. You don't know in 5 years' time what their businesses are going to look like if antitrust becomes a big thing, whether we're talking about the Trump administration, a second term for Trump, or if there's a Democratic administration that comes in. It seems like both groups are equally willing to take out that antitrust card and play it. And we've seen the sort of thing before with antitrust. It's a way to sort of cut really big companies, powerful companies down to size. So I like you said, we're going to have to see how it plays out. It will take a long time, but it may be, to me, it may be showing that the future may not be what the past was for these big companies. Any last words, guys, and I'll wrap it up. Ted?
Can I one thing on that point? There's also the idea that actually monopolies. Peter Thiel has written a book called 0 to 1, and it's the idea that monopoly power is actually better because you have companies that aren't waging price competition wars. Like, that's why Verizon and AT&T can't be innovative like Google, because Google has monopoly on search. So it gives them the whereabouts and the means to go develop all these new technologies that are good for society as a whole, because they're not stuck in a war. I mean, Could you imagine if like Time Warner Cable, we had to rely on them for innovation? It's impossible to get them on the phone for customer service. So I do think that there is upside to having a monopoly in certain areas of society.
Wow. Okay. That's an interesting take. Ted, last thought.
Well, with all due respect to Peter Thiel, I think the main issue that's going to be considered in these debates is actually not going to be about monopoly as much as it is about the impact that these companies, as they are structured, have on the rest of society. And really, that's not an economic issue. It's a social and political issue. So I've long maintained that what we really need is to throw away our existing assumptions about what antitrust policy should cover and actually start looking at it in a new way for a new reality. And in that respect, it may not matter what monopoly pricing does for these companies. What matters is how it affects other processes like our political system, because I think that's what's driving the concern.
All right, well, guys, I will kind of wrap it up there, but I appreciate both of you coming on, and just, thanks, Ted. Thanks, Ian.
It's a pleasure.
Thank you. Good seeing you.
And, for all of you, my thoughts here are just thank you for joining us on this Saturday Market Insight. And our goal in all this is just to help you navigate the issues that are going to be affecting or are affecting your stocks. And we'll have a brand new Saturday Market Insight next week. So make sure to look for that in your email. So for Ian, myself, and Ted, and all of us at Sovereign Investor Daily, thank you for watching.